Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. In this session, we're tackling a topic that's at the heart of SBA lending, but often gets overlooked: how to evaluate risk and return in closely held businesses. This isn't just about crunching numbers. It's about seeing the big picture, understanding the gamble a borrower takes when they pour their life savings into a business, and how you can protect them and your portfolios. When a lender greenlights an SBA 7A loan for a business acquisition, they're not just approving a loan, they're enabling a high-stakes investment. Unlike someone buying stocks or mutual funds, the borrower is betting almost everything on one illiquid, risky asset, a small business. So the million-dollar question is, does the return from that business justify the risk they're taking? And do they have the tools to measure it right? Let's clear up a big misconception. Net income is not the best way to measure return. You might see financials with return on equity (ROE) based on book value and net income. But that can be misleading. Book value doesn't reflect what the business is actually worth. What should we use instead? Net cash flow to equity. That's the cash the owner keeps after taxes, capital expenses, working capital, and debt payments. Then, compare that to the fair market value of the business, not book value. Here's the formula: market-based return on equity, net cash flow to equity, fair market value of equity. This gives you a true picture of the economic return the owner's getting. Risk in private companies isn't just about market swings. It's messier. Think customer or supplier concentration. One big client leaves, and the business tanks. Owner dependence. What happens if the founder walks away? No succession plan. Who's next in line? Single location. A local downturn could hit hard. Emotional decisions. Owners aren't always rational. These risks are tough to quantify, like stock volatility, but they can have a significant impact on the value of the business. Here's another harsh reality. Most SBA borrowers aren't diversified. They're sinking 70, 80, even 90% of their net worth into one business, plus signing a personal guarantee. That means their financial future rides on one company. There's no liquidity, no easy way to cash out. Emotions can cloud smart financial choices. Lenders have to ask, is this borrower too exposed? Can they weather a storm if the business stumbles? Evaluating risk and return for small businesses isn't easy. Here's what you're up against. Hidden risks. Things like customer concentration or owner dependence aren't always obvious in financials. Data gaps. Small businesses often lack robust data to estimate cash flow volatility accurately. Borrower pushback. Buyers may downplay risks, focusing only on upside potential, making objective underwriting tougher. So, how do you get this right? Here's your playbook. Focus on cash flow. Use net cash flow to equity, not net income, for return calculations. Calculate market-based ROE based on fair market value, not book value. Consider risk. Weigh return against known risks and hidden risks like customer concentration. Check diversification. Ask how much of the borrower's net worth is tied up and if they've got a financial cushion. Require annual valuations. Post-acquisition, encourage yearly updates to track value and risk. Benchmark returns. Compare the business's return to other investments, stocks, bonds, real estate. Is it competitive for the risk? Bottom line, private companies are risky. Lenders have to weigh all the risks and price that risk into lending decisions. Let's wrap this up. Lender analysis must go beyond the P&L or balance sheet. Lenders need to see the business as an investment, with risks, returns, and a place in the borrower's financial life. When the business thrives and risks are managed, everyone wins. But if the risk is too high, the return too low, or the borrower too exposed, there could be trouble. Lenders, ask the tough questions, dig into the risks, and protect your borrowers from overexposure. That's how you build stronger loans and better outcomes. Thanks for joining us for this episode of the Valuation Desk. At Highland Global, we bring decades of hands-on experience to every appraisal we deliver. SBA lenders trust us because we understand what's at stake: accurate, credible valuations that withstand scrutiny and support sound lending decisions. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.